Hi, I'm Sunil Maheshwari, Professor of Accounting at Indiana University of Pennsylvania. We will talk about responsibility accounting today. In any organization, people do come together for a certain purpose. And when those people are assigned, when individual or group of individuals is assigned a certain responsibility, it is basically a responsibility center or a segment or an individual. Uh, it extends to any level, it might extend to any level of management, and it especially works well in a decentralized company. Now, how is responsibility accounting different from budgeting? There are two main differences. One relates to the controllable cost and uncontrollable cost. In the responsibility accounting, we need to distinguish if the costs are controllable or non-controllable by that particular individual or that responsibility center, so that we are able to evaluate the performance. The emphasis will be on controllable cost by that individual manager so that performance of that individual manager or that unit or the responsibility center can be evaluated. It will apply to both profit entities as well as not-for-profit entities. Now, all the costs are controllable at certain level, but all the costs may not be controllable at all the levels. For example, in a university setting, a professor may not be able to control the cost relating to the compensation for the president of the university. However, the same cost may be controllable at the level of board of governors at, for the university. So a cost that is controllable at one level may not be controllable at another level. So we are emphasizing on the controllable costs. Based upon the costs that are controllable, we also need to be able to evaluate the performance of the managers or the responsibility centers. What we can do is we can compare the actual with the budgeted, especially the flexible budget goals. The performance evaluation also have two aspects. One is the behavioral aspects, and the second is the reporting principles. Now we'll talk about the behavioral principles relating to performance evaluation. First of all, you should not be evaluating a manager for anything for which the manager is not in charge of or is not in control of. Top management should support that evaluation process. And evaluation process must also allow the managers to respond to their own evaluation in case there is a disagreement with the supervisor. As far as the reporting principles are concerned, we will try to find out the profit which are controllable by the responsibility center manager, so that we can evaluate the performance accurately for that manager. Based upon the responsibility, there are three types of responsibility centers which we will talk about. First is the cost center. If a responsibility center or manager is only in control of the costs that are incurred in that particular responsibility center, it is referred to as a cost center. In this case, managers have the authority to incur costs, and usually it refers to a production department or a purchase department where all these costs are incurred, and managers are expected to perform at an optimal level while keeping the cost in control. In case of profit centers, managers are responsible not only for the cost but also for the revenues generated, and managers are judged on the profitability of those profit centers. So examples can be an individual department retail store or a branch bank office, or it can be as big as a one of the locations for, say, a GE factory in Detroit. As far as the investment centers are concerned, it incurs costs, it generates revenue. In addition to those two features, it also has some investment funds that are available at its discretion. And managers are expected to generate certain return on their investments. Managers are generally evaluated on the profitability of the center and rate of return earned on these funds. And managers should be, again, able to influence decisions and be able to control the decisions relating to all these investments. So this is a graphical representation of the three cost centers. The first one shows the cost center where only expenses are controlled by the manager. In the second case, expenses as well as revenues are controlled. And in the last case, expenses and revenues as well as return on investment needs to be looked at to evaluate the performance of the manager. As far as the cost centers are concerned, the responsibility for the manager is generally limited to meeting the budgeted goals for the controllable cost. And in this case, for example, in a production department, in a production environment, you might be required to make a particular product within a certain standard cost. And the report should only include controllable costs. Here is an example for a cost responsibility center, cost center. And you've got the indirect labor and indirect material and utilities, and you've got the budgeted, which is generally the flexible budget compared to the actual. And in this case, the person is only responsible for the cost. And if your budgeted cost was $13,500 for indirect material and actual is $14,000, you've got an unfavorable variance of $500 and so on. So in this particular example, the budget was $40,000, but overall there was a favorable variance of $400 for this cost center. As far as profit center is concerned, the report should contain items in which managers have control over both the operating revenues earned and the variable costs incurred in the center, because these costs will vary with the sales. There's a distinction that everyone needs to know regarding the direct cost and the indirect fixed cost. Direct cost would relate specifically to one responsibility center. So if you close down that particular responsibility center, those costs will go away. So in case you've got a Macy's store at the mall and that particular Macy's store is closed, you really don't need the manager at that store who was working. So that particular cost can be directly related to that particular Macy's store. And these costs are therefore incurred for the benefit of that center only. Most of these direct fixed costs are controllable by the profit center manager, and that's why it should be their responsibility. This is as opposed to the indirect fixed costs, which are common to the company as a whole. And these common fixed costs cannot be controlled by the profit center manager or profit center manager. For example, if you take the CEO's salary for a company, even if the manager of that particular profit center wants, may not be able to control the salary of the CEO that is allocated to that particular responsibility center. So these are called common costs since they apply to more than one center. Another example could be corporate legal costs, which are common to many units. and generally you will not be able to avoid them even if you close down one of the centers. So those costs are incurred for the benefit of the company as a whole and or for more than one profit centers. Now, in terms of reporting, uh, you have to report the budgeted and actual controllable revenues and cost. What you can do is you can start with the cost volume profit analysis income statement, or the what we call the contribution margin income format. Once you get the contribution margin, you can deduct the controllable fixed costs from the contribution margin. And anything that it exceeds, any contribution margin that exceeds the controllable fixed cost is referred to as the controllable margin. Generally, we'll avoid reporting non-controllable fixed cost as part of that statement, and that can be reported separately just to let everyone know that some costs which are uncontrollable will be allocated later on, and it might impact the profitability. But as far as the evaluation is concerned, it should be based upon the controllable margin only. Here is an example. If you look at the budget and the actual generally flexible budget, as mentioned earlier, you've got the sales less the variable cost budgeted as well as the actual. And then you've got the variance in the fourth column, which is favorable or unfavorable depending upon whether it's a cost or a revenue item. So in this case, you've got the budgeted contribution margin of 540,000 against an actual contribution margin of 504,000, giving you an unfavorable contribution margin of 36,000. Out of those 540,000 and 504,000, we have taken out the controllable fixed cost, which was 180,000, and we come to the margin of controllable margin of 360,000 and 324,000 for the actual. This controllable margin is generally used for the evaluation of the performance of that particular profit center manager. As far as a investment center is concerned, you can compute the ROI or return on investment to show the effectiveness of a manager in using the assets at his or her disposal. This is one of the very common performance measure and a very useful performance measure which is used in the industry. Generally speaking, factors which are in the formula should be controllable by the manager. However, there might be different interpretations in different organizations of the same formula. So return on investment can generally be defined as what's the money you're making on the investments that is there. It is a ratio, that is one number that is divided by another number. It's a simple ratio. You've got the controllable margin, which we explained earlier, divided by the average operating assets. Average operating assets will consist of the current assets and the plant assets that are used in operation by the center. These assets are in control of that profit center manager, or in this case, investment center manager. To compute the average operating assets, we take the beginning of the assets and the end book value of the assets and divide by 2 to get the average operating asset. So in this case, return on investment is 20%. And if this return of investment 20% is more than the minimum that is desired by the organization might desire a minimum return of 15%, then the ROI center manager is doing very well. However, if the minimum return desired by the organization is say 25% or 22%, then ROI manager, probably the investment center manager, needs to improve the returns. In the formula, as I said, there might be some judgmental factors in terms of the numerator as well as denominator. So as we said, operating assets could be defined as sometimes some companies might use the book value, some companies may use fair market value, but whatever is used needs to be used consistently. Similarly, although we prefer the controllable margin, some companies also use income from operations or net income as to compute the return on investments. Now, you can always improve the ROI by either improving the controllable margin or by reducing the average operating assets. So if you've got the controllable margin of 600,000 and average operating assets of 5 million, you've got a return on investment of about 12%. What is the problem with the ROI? The problem with the ROI is that sometimes the managers might tend to make decisions which are not in favor of the company as a whole. For example, you've got right now a controllable margin of 20%, and Pujol division, electronic division has an ROI of 20%. Now, if they want to add, say, another investment or another product tracker which can generate a return of 13%, that is, you've got the controllable margin of 260,000 for an average operating assets of 2 million, then what happens to the ROI for the company as a whole? For the company or as a whole, the ROI goes down to 18%. So sometimes there might be resistance on part of the particular profit center manager or investment center manager to not use or not include tracker because it reduces the overall ROI from 20% to 18%. But the problem is due to the fact that it ignores the minimum rate of return that a company needs to generate on its operating assets. So an alternative to that is residual income. In the residual income, we take the controllable margin and subtract the minimum rate of return that is desired on the average operating asset. That is basically the interest cost of using that money in a way. Once we do that, if there is a positive residual income, then the investment should be a good opportunity to invest. So it removes one of the limitations of the ROI, but it may have its own limitation as well. It ignores the fact, the residual income ignores the fact that one division might use substantially fewer assets to attain the same level of residual income. So if you can attain a same residual income using half the assets, then that particular unit is much more efficient. For example, in this case, for tracker, you've got a controllable margin of 260,000 with average operating assets return of 10% of 200,000. You've got residual income of 60,000 with assets of 260,000. Whereas for CDOG, same residual income requires an investment of 460,000 to achieve the same goal. So based upon your objective, you can select whether to use ROI or RI for the comparison purposes. Theoretically speaking, RI is a better measure. So overall, what we have done today is we went through the three responsibility centers: cost center, revenue, profit center, and the investment center, and then how to evaluate each of these responsibility centers, given the fact that the controllable cost or controllable margin will be the guiding factor to decide the performance and efficiency of a particular responsibility center. Thank you very much.